Hi everyone, welcome back to the channel. My name is Courtney and today we're going to be discussing dollar cost averaging, which in my opinion is one of the best investing techniques in personal finance. I've always thought of dollar cost averaging as the bedrock of good personal finance, since it serves two fundamental purposes: minimizing risk and establishing good financial habits. So let's start with the dictionary definition and then analyze how it covers both of these topics. Next, we'll walk through a quick example of how this works. The Investopedia definition of dollar cost averaging defines it when an investor divides the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. If we peel back all of that financial jargon, all this is really saying is that instead of making one big financial investment at a time, you should spread out this investment into smaller periodic chunks. The reason for this is simple, and that's because the stock market is volatile. Even if you're investing into ETFs and index funds, there can still be a lot of volatility, meaning that the stock prices can go up and down on any given day. So by spreading out your investment purchases, you're smoothing out those fluctuations and minimizing the risk of there being a big drop in the price of these investments right after you buy them. Besides risk reduction, this method is a really great way to establish strong financial habits. If you get into the habit of investing at a regular frequency, you'll be much more better situated for growth down the road. One of the best financial sayings is time in the market is better than timing the market. And all this really means is that it's better to have your money in the market and just let it grow over time rather than trying to buy in at a specific time whenever it's low. So let's walk through an example of what dollar cost averaging might look like. Let's say you have $1,500 that you're looking to invest. Instead of investing all of that money on the same day, maybe try investing the first $500 during the first week, the next $500 during the next week, and the following $500 a week after that. And that way, if there is a small market decline, you won't experience that on all of your money. At the same time, if there is a nice stock market boost, then you'll get to experience that on at least some of your money. So it's really the best of both worlds. And the amount of time that you choose to have between investments doesn't matter as much as the general idea of it. And to make this a more automatic approach, financial institutions like Vanguard and Fidelity allow you to invest a given amount at a specific time period during the month. So if you automatically set these investments every month, this will smooth out fluctuations within the market and put you on your way to financial success. So I know that was a quick overview of a very important topic. So if you have any questions, please be sure to let me know in the comments below. If you like this video, please be sure to like and subscribe. And I hope you all have a wonderful rest of your day. Bye.